There is one American oil play better than all the others, and I've found the single best way to profit from it. And this horizontal oil play isn't big, it's huge. Use your imagination and come up with a big number. Try and guess how many barrels of oil this play has, and your guess will be low. This one will knock your socks off. Maybe you think it's the Bakken. The Bakken was one of the launch pads for this horizontal oil revolution. And make no mistake, the Bakken is a giant oil play. In April 2013, the U.S. Geological Survey updated its estimate of recoverable oil in the Bakken to 7.4 billion barrels. The Bakken and its production ramp has created countless millionaires. But the horizontal play I'm talking about absolutely dwarfs the Bakken. Perhaps you think the play I'm talking about is the Eagle Ford. Now that's a good guess. The Eagle Ford is considerably bigger than the Bakken. The USGS estimates that the Eagle Ford has 10 billion barrels of recoverable oil. The Eagle Ford is giant in its own right, but even its 10 billion barrels doesn't come close to the play that I'm talking about. In fact, the giant horizontal oil play that I'm talking about is so big, the only play larger than it in the entire world is Saudi Arabia's legendary Ghawar field. And over time, this horizontal play may prove to be even larger than that. The play that I'm talking about, the play that's going to dominate the oil industry in North America over the next 10 years, is the West Texas Permian Basin. The Permian isn't just the biggest horizontal oil play in North America, it's the biggest by a wide margin. What makes the Permian so special? It has multiple oil-bearing zones stacked on top of each other. The Permian is so big, so loaded with oil-soaked rock, that it's like having 4 to 6 Eagle Ford shale plays stacked on top of each other on the same land. Imagine how valuable that land must be to oil and gas companies. For an oil company owning 1,000 acres in the Permian, it's like owning 4,000 acres in the Eagle Ford or the Bakken. You know the old saying, they aren't making any more land? That saying applies in the Permian in a big way. There is a rush on to lock up all of this oil-soaked acreage. Land in the Permian is extremely valuable. And the value of that land is why I'm so excited about my most recent subscriber stock pick. It's a small company with a shockingly large amount of land. Land that's right in the middle of the Permian. This company locked down a huge chunk of land before Permian land prices skyrocketed. I'm talking about tens of thousands of acres in the core of this huge oil play. All of that land is held by an off-the-radar company that nobody has heard of. Nobody except the major oil and gas producers that are drilling like mad all around this acreage. Major oil producers that are looking at this little company's large acreage and drooling at the chance to swallow it up. I'd love to tell you about this little company that very few investors outside of my subscriber base have even come across. It's a true hidden gem. And it's sitting in the heart of the biggest oil play in the history of North America. Production started in the Permian way back in 1923 with a gusher of an oil well that set off a classic oil rush. Since that first oil well was drilled, more than 29 billion barrels have been produced from the Permian. We're talking big Texas oil here. All of that production was from conventional development using old school vertical wells. And those old wells left a lot of oil behind. In the Permian, we're talking about billions and billions and billions of barrels left behind. Oil that has just been waiting for a solution. Enter horizontal drilling and multi-stage fracturing, a modern-day solution for a decades-old problem. How do we get all of that oil out of rocks that wouldn't come out in a vertical well? Horizontal drilling unleashed the potential of the Bakken. Horizontal drilling unleashed the potential of the Eagle Ford. And now the world is just beginning to see what horizontal drilling can do for the biggest granddaddy oil field of them all. This old Permian dog is about to show some new tricks. 29 billion barrels have been produced from the Permian since the 1920s. But just how much is still in the ground, just waiting for a new technology to help bring it out? It's hard to say. In 1995, The USGS issued a report that said the Permian had more than 100 billion barrels of oil in place. That means there are at least another 71 billion barrels left in the Permian for companies to chase. But today, even that 100 billion barrel figure is starting to look conservative. That figure is 20 years old and needs to be updated. Most companies active in the Permian believe that the 71 billion barrel figure is low. We're starting to be reminded of something we already knew. The Permian is North America's version of Saudi Arabia. What separates the Permian from the other horizontal plays is that the Permian is really a lot more than one single play. The Permian is a play on top of a play on top of a play. Many of the Permian stack zones have the potential to be significant oil plays in their own right. Add them all together and you are talking about the most oil-laden stretch of land in North America. Over the 4 basins that make up the Permian, there can be more than 10 productive zones. The industry is now figuring out which zones to drill horizontally first. Booming horizontal wells are being reported weekly. The Permian is the hottest oil play in the world right now, and everyone wants in. U.S. securities firm Raymond James said there are more than 700 rigs operating in the Permian Basin now. That's astounding. That is more than 1/4 of the rigs operating in all the U.S., and over 10% of the rigs operating in the entire world. With that much drilling, there is only one way for production to go: up, up, and away. Production in the Permian is already up 400,000 barrels a day since 2012 and is now near 1.5 million barrels a day. The industry loves the Permian and its stacked zones. Buy one piece of land, get multiple oil plays. This play is a dream for oil producers. Being able to tap into multiple zones on the same piece of land makes getting all that oil a lot cheaper. You can chase multiple oil zones using the same rig. You can drill into multiple zones from the same drilling pad. That's the good news for oil producers. But there is some bad news in the Permian. Almost all of this coveted Permian land is already spoken for. Because the Permian has been drilled for decades, the land in the play was leased by oil companies years ago. There isn't any unleased land for companies to run out and grab. Finding a large land package in one big chunk in the Permian these days is virtually impossible, and that makes for sky-high land prices. If you want to acquire acreage in the Permian, you're going to have to pay for it. Even land on the edges of the play that's not drilled is expensive. In 2012, Japanese company Sumitomo paid Devon Energy $7,000 an acre in a joint venture on non-producing land, targeting just 2 Permian horizontal zones. At that point in time, the zones that Sumitomo paid that handsome price for were still basically unproven. Since then, the Permian has only gotten better. Thousands of wells have been drilled, further proving up the oil treasure that lies in the various stacked zones. And as the play gets better, and companies more comfortable with the productive capability of the zones, the land gets more expensive. For oil companies wanting to enter the Permian, expensive land prices is bad. For me and my subscribers, expensive Permian land is good. Because my latest subscriber pick has a large acreage position in one big chunk right in the middle of the Permian. This little company's acreage is surrounded by larger companies. This is land that was locked up by this little company before Permian land prices went ballistic. Before the entire industry got turned on to the Permian as the next big thing in horizontal oil development. The most confusing thing about the Permian, since it went horizontal, is figuring out which of the stacked zones to focus on. Many of the zones on their own are big enough to be exciting horizontal oil plays. But there are a couple of Permian zones that really stand out. Zones that are company makers by themselves. The Cline Shale is one zone that is pretty hard to look beyond. One of the companies leading the charge into the Cline Shale is Devon Energy. Devon is a big experienced player and is very excited about the Cline. Last year, based on its busy drilling program, Devon announced to the world the amount of oil that it believes the Cline Formation alone contains. Now keep in mind that the Cline is just one of the many oil-soaked zones in the Permian. Devon's estimate for the Cline was a staggering 30 billion barrels. That's correct. The Cline Formation alone is bigger than the Bakken and the Eagle Ford combined. And the Cline is just one of the many formations in the Permian. What is also exciting about the Cline is that it's thick and it's overpressured. That combination makes for some big wells. Companies drilling wells in the Cline have been reporting some boomer results. Pioneer Natural Resources has drilled 3 recent Cline shale wells with initial production rates exceeding 1,500 barrels a day. And 2 of those wells came on at more than 3,000 barrels a day. Those are monster wells. Those are the kinds of numbers you might see from a big conventional oil play, not a horizontal well getting drilled into a tight or shale oil target. The Cline also has really light oil, Texas T, which is worth a lot these days. High quality oil combined with high production rates makes for big profits. No wonder Permian land prices are so high. A study completed by Chesapeake Energy suggested that every square mile of the Cline Shale contains 3.6 million barrels of recoverable oil. 1 square mile equals 640 acres, so for every 10,000 acres a company has, there are 56.5 million barrels of recoverable oil. It doesn't take a lot of land to make for some big reserve numbers in the Cline. And that's why my latest subscriber pick is my favorite way to play the Permian. Because this company doesn't have a little bit of Permian acreage, it has a whole lot. Tens of thousands of acres. This little company has huge leverage to Permian land prices. Now you can see why I'm so excited. But remember, the Cline Shale is just one zone in the Permian that contains oil. In fact, it isn't even the zone with the most oil in the Permian. The Cline Shale by itself is enormous. 30 billion barrels of oil. 3.6 million barrels per square mile. It's bigger than the Bakken and it's bigger than the Eagle Ford. And that makes it hard to imagine that there is another zone that is also in the Permian that's even bigger. That zone is known as the Wolfcamp Spraberry. Where the Cline is estimated to contain 30 billion barrels, the Wolfcamp is estimated to have 50 billion barrels. That doesn't just make the Wolfcamp a large oil play, it makes it the largest oil play in the entire world that isn't named Gawar. No wonder that land in the Permian is so sought after. You can see why oil companies are paying top dollar for even non-producing Permian acreage. Acres in the Permian are loaded with more oil than any other place in the world. Operators have been drilling through the Wolfcamp on the way to conventional targets since the 1920s. Everyone knew about the Wolfcamp, but didn't have the means to exploit it. Horizontal drilling and multi-stage fracturing have unlocked this monster formation. With 300 feet of thickness, the Eagle Ford is known as being a thick shale formation. The Wolfcamp Spraberry is 10 times as thick. 3,500 to 4,000 feet of shale oil exist in the Wolfcamp Spraberry. As I said earlier, owning acres in the Permian is like having 4 Eagle Ford shale plays stacked on top of each other. Oil upon oil upon oil. What really sets the Wolfcamp apart and makes it so sought after is not only its size, but also that it's consistent across the entire play. Consistency is the key in the horizontal game. As the play moves east to west, the Wolfcamp is uniform and consistent. That makes the play predictable. And that makes investing huge sums of money and rolling out massive drilling campaigns possible. Operators know what they are getting when they drill a Wolfcamp well. The consistency of the Wolfcamp is why companies are paying top dollar for acreage in the Permian. And like the Cline Shale, the Wolfcamp is producing some enormous wells. Companies like Apache and Concho Resources have regularly been reporting Wolfcamp wells with IP rates over 1,000 barrels a day. Operators learn a little more about the zone with each well that gets drilled, which makes the next well even better. The Permian is booming, and if you want to play, you have to have some land. My latest subscriber pick is right in the middle of the game. 4 Eagle Fords stacked on top of each other. This little company and its large contiguous land base has the big boys that surround it licking their lips. And this little company is still dirt cheap. For now. The fact that the Permian Basin is loaded with oil is not a secret. That should be pretty obvious. And no surprise, stock prices for Permian-focused players have been flying high. Even huge companies like Pioneer Natural Resources have had their stocks explode upwards because they have exposure to the Permian. Going from $80 to $220 a share in the last 18 months. Pioneer Natural has added more than $10 billion to its market cap because of its Permian Basin success. The Permian has already created billions of dollars of value for shareholders. Non-producing Permian land is worth thousands of dollars an acre. Producing Permian land is worth tens of thousands of dollars. If an investor wants exposure to the Permian today, he's going to have to pay up to get it. The Permian is the hottest oil play in America, and the stock prices of Permian players reflect that. Or so I thought. Until I found one little Permian-focused company that had slipped through the cracks. And while this company may be little, its Permian land position is big, really big. At the current share price, this little company provides more leverage to the value of acreage in the Permian Basin than any other company. That's why I've told my subscribers that this is the Permian Basin company that they have to own. This little company has a huge land position in the Permian Basin. A land position that has many layers of stacked oil zones. A land position that is surrounded by much larger companies, which are drilling booming oil well after booming oil well. How is that possible? How does a small company with a huge land position in America's hottest oil play get missed by the market? The answer is the market isn't always efficient. Sometimes circumstances exist that result in incredible bargains. It doesn't happen often, but if you work hard enough and look long enough, you will find exceptional opportunities. Exceptional bargains. Bargains like this little company. Let me be clear, this isn't a misunderstood company that the market is mispricing. This is a company that the investors simply aren't aware of. It's a company that has fallen through the cracks. This is a company with a big land position in an established area of the hottest oil play in the United States. A land position that isn't hard to determine the value of. But the big oil companies drilling all around this land package are perfectly aware of what's going on. These big boys are circling my latest subscriber pick like a bunch of hungry sharks. So how did this company fall through the cracks? First off, this company is small, which means that the institutions are not going to pick up on the story unless analysts force feed the idea to them. And this company has only one analyst following it besides me. So there's no force feeding going on. That means the institutional investors, the really big money, the money that drives share prices, haven't come across this company. In addition to having only one analyst cover it, this company is not promotional. This management team keeps their heads down and does their work. The company doesn't hit the public relations trail. The company doesn't present at the usual monthly industry conferences. Unless you spend all of your time looking for bargains in the energy sector, this company isn't going to find you. You have to find it. This is a stock price created by neglect, but forces are at work to change that. There are catalysts on the horizon that are going to force the market to wake up to the fact that this company has a huge position in America's hottest oil play. So time is of the essence. I'd love to tell you about this cheap stock before the catalyst arrives. There is big upside to be had here, and that upside is going to be realized soon. The stock price of my latest subscriber pick has some serious catching up to do. In 2013, on the back of booming drilling results, an index of Permian-focused producers increased by 81%. Meanwhile, the share price of my latest subscriber pick didn't move at all. This despite the company increasing production and having outstanding wells drilled all around its big piece of acreage in the Permian. 2014 should be the year that the neglect ends and the catch-up happens. There is definitely a clock that is ticking. Forces are at work and the wheels are in motion. I want to tell you why this little company with its big land position is the Permian player to own for 2014. So if you're interested in this play and looking to capitalize alongside me from the booming junior oil and gas markets, let me give you this report, risk-free. And really, this is the best time to be investing in North American energy. Oil prices, and now natural gas prices, are up. And my subscriber portfolio has never been doing better. I've booked over $160,000 in gains in the first 2 months of 2014, over 30% return. My open trades at this time are doing even better. They're up 65%. Here's a look at one of my open positions. Pacific Ethanol is a NASDAQ-listed company that makes ethanol on the West Coast. They also market other people's ethanol and have a dominant position in their markets. I bought the stock just over $3 in November 2013 after a bad quarter made investors nervous. But I knew the ethanol market was turning fast as a bumper corn crop was lowering the industry's input costs. As ethanol margins soared from pennies a gallon to $1.25 a gallon in just 3 months, the stock flew up to $16. I've sold half my position at a double and now ride for free. I still love the company. Here's a look at a few other big gains in the portfolio. A 550% gain with Canadian Energy Services, symbol CEU on the Toronto Stock Exchange. I've owned it for 4 years. Dividends keep increasing. Another OGIB success story, a 781% gain with natural gas producer Donnie Creek Energy. I knew management well and followed Donnie Creek since the day it listed at 37 cents. They are the best landmen in Alberta. They were able to assemble an incredible land package right under the noses of Calgary billionaires, and they hit on all their wells. I recently sold stock as high as $2.89, a 781% gain. Each morning, I read a lot of research from Canadian and U.S. brokerage firms. I can tell when they believe what they're writing. If I see a stock I like, I phone management directly and then download all the investment research off the web. I translate all that information into simple English for my subscribers. No words over 9 letters, I say. Sometimes I use my connections to source big gains for my subscribers. One of my mentors told me in mid-2013 that one of the top management teams in Calgary had announced a bottom-level financing. They were starting a new company. Both me and my subscribers were able to quickly triple our money as the market found out what I already knew. These are a few examples of how I trade oil and gas stocks. And while I've traded this market for many years, it was just a few years ago that I decided to give up my high-paying job as a writer and analyst to start my own service. A unique service, unlike any other I've seen. That's because it's my personal portfolio. I opened up my portfolio so that subscribers can follow my trades and have the opportunity to profit alongside me. I manage my service with full transparency. In other words, when I buy and sell stocks, I tell you exactly what, when, and why. That way, you can understand what goes into each trade and can decide if it's right for you. Of course, my service isn't for every investor, but it's a model that seems to be working for my subscribers. And let's face it, if I'm not making my readers money, they're not going to renew their subscriptions. It's as simple as that. Because the truth is, I'm putting my money on the line every time. And I have yet to find another trading service that has the transparency to go along with the track record. So when I'm taking gains in my energy trades, you'll have the opportunity to do the same thing every time. Which is why I feel $4.99 is a fair price for access to my trades. I've found it a modest fee, considering the track record, the gains on the table, and the level of research I offer. It's not uncommon to pay $2,000, even $5,000 for this level of research, let alone for a real-time trading service like mine. But I want you aboard. That's why I'm offering a special discount. You can now get my OGIB service for just $39 a month. That's 20% off the regular monthly rate, the retail price you'd pay if you weren't already a subscriber of my free alerts. By taking my quarterly plan, you'll not only get the same 20% discount and pay just $99 every 3 months. At $99, I give you a full 30 days to test drive my service and see if it's the right fit for you. And the minute you sign up, you'll get the full write-up on the hot new Permian trade I've gone over with you today. But the potential for gains doesn't end there. You'll also get my new report on my Nat Gas Trade of the Year. Its wells pay out very fast, and they are more than doubling production this year. You'll also get access to the complete report on another big trade, a junior oil play that has just made an exciting new discovery. The market is only starting to understand the potential here, but it won't be long now. And lastly, I'll include my top energy services stock. They have very high profit margins. And demand is so hot for their services, their suppliers can't get them new equipment fast enough. So here's the full tally of what you'll get as a new member of my Oil and Gas Investments Bulletin service. Investor Report number 1, the Permian play you want to own today, right now. And the number 1 natural gas stock with fast payouts and huge growth. And the junior oil stock the market is now discovering, long after me. And my top energy services pick, whose revenue and cash flow are soaring. You'll also get password-protected access to the OGIB website. You can now get my OGIB service for just $39 a month. That's every position in the portfolio, the full history, and every single report we've ever published. I'll also be sending you portfolio updates along with urgent buy-sell alerts directly to your email inbox. Remember, you can cancel at any time with no obligation and no questions asked. One more thing to keep in mind. I was one of the first investors in Alberta's Cardium play in 2011 and one of the first investors in ethanol stocks in 2013. Today I'm looking for the same successes from the Permian play in Texas. My subscribers had the opportunity to make and take enormous gains. It could be a repeat of the original Bakken, which made fortunes for thousands of individual investors. So if you want the opportunity to profit and prosper from the next big Permian play before it's discovered by the North American mainstream, a junior company with a massive land position in the heart of prolific production, I urge you to become an OGIB member today. Act now. Click below to get started.